Joining me now, Post 9, Evercore's Roger Altman. It's good to see you. Welcome down here.
Pleasure, Scott.
So we have more rough times ahead?
I just think it's going to be hard for markets to do well between now and the end of the year. The level of interest rates, as you've been talking about so much, at the margin makes bonds more attractive than stocks. I mean, if you have about a 5% yield on the 10-year, and you're looking at all this uncertainty, whether it's in Washington or whether it's hard landing versus soft landing, it's not a bad place to be, at least temporarily. Mm-hmm. And then you have some fresh concern about whether we can really count on a soft landing with this level of interest rates and some other factors. And then you have the mess in Washington, and in particular, the likelihood of another shutdown. And anytime you don't have a Speaker of the House, which is a position which is cited directly in the Constitution, that's not a good thing.
Yeah.
Then you have some fresh concern over the fiscal trajectory of the country, which I think is quite poor. And it manifests itself in a massive supply of treasuries, of course, but also just no interest in Washington in addressing it. And when you have a roughly $2 billion deficit, when the economy is as resilient as it is right now, and the outlook for the debt to GDP ratio as it is, it's not good.
So rates have obviously backed up a bunch. You know, we're talking about the prospects of a 5% 10-year. How high do you see rates going? Are we getting to the point where we just moved a little too far, a little too fast, and we're going to stop this upward momentum some point soon?
Of course, it's hard to know, but my best guess would be they're not going to go a lot higher, because we have an environment where inflation, even though it's stubborn, is coming down. And that's obviously good because people focus on real returns, as they should. And I also think the economy is more likely to be softer at the margin than stronger, which obviously is a positive from the point of view of a cap on yields. So I would doubt that rates are going to go a lot higher, although there is a sense, as you know, that the so-called neutral rate, the rate at which the economy is neither expanding or contracting, should be higher than people have been thinking it would be. And I think that has a fair amount to do with why rates have jumped up like this. But are they going to go a lot higher? I would be surprised.
I mean, I think that, the Fed's obviously trying to figure out if the neutral rate is in the right place.
Right.
Yeah, Rich Clarida, I mentioned it earlier today. The former vice chair suggests, maybe they are done. And you have to believe they want to be done. They don't want to inflict undue harm on what's been a better economy than even their forecast suggested it would be. Let's not forget, they got the forecast on the economy incorrect, and they've gotten the forecast on inflation incorrect. So
a historical error, I might say.
And that's going to be talked about for decades. But what do we do with it? What do we do with it now? What if there's enough still in the economy that they can pull it off?
Well, as you know, the futures market at the moment is signaling that it's not very likely the Fed will hike again, at least this year. I think that makes sense, because if you're the Fed, you're surprised, I think, by this level of open market interest rates, not the overnight rate you control, but the 10-year, the 30-year, et cetera. I think you're surprised by that. You're a little concerned as to how much it is tightening financial conditions in addition to what you've done at the Fed.
Well, the lag effects haven't even,
that's right.
They've got to be wondering, wow, we thought the lag effects would already be starting to take hold. Now, maybe these are the first winds blowing in before the storm does, but that's been somewhat of a surprise, too, and they probably think that there's more to come. Yeah,
so I think if you're the Fed, you're feeling cautious. I think the mentality probably is at the moment steady as she goes, no change. And as to next year and when they will cut, how many cuts, I just think that's data dependent. We just aren't going to know that for a while.
You think, though, that they will cut rates next year?
I do. And I think that because I think it's going to be hard. The economy has been remarkably resilient, but there are some factors that are more downbeat. Apparently for 80% of Americans, the surplus pandemic-related household savings are now gone. And that's going to work its way through on consumer spending and retail. The top 20%, yes, still pretty flush, but the everyday American consumer not as flush as she was 3 months ago, 6 months ago, and so forth. So, and a few other factors, I think, that are going to cause the Fed to feel more. I mean, we have to wait and see how inflation progresses, but I think they'll hit their target on inflation in the next medium term, and I think they'll cut rates I'm not sure how often, but they'll cut rates starting next year by mid-year.